Hi friends, welcome. So gradually we are bringing the term to a close. I'm sure we are all tired. We need some break, some summer break. But good enough, we are having some spring break, right? So you take that point to reflect, to rest. Okay, and then once in a while you look at the questions, you look at some questions online, revise one or two stuff, but take some break, okay? Reflection is a key part of our work. I will take a rest. We should also take a rest. We're looking at taxation. Okay, IAS 12. Most just sentence. We will center our discussion on the deferred tax component only. All right. I'll split it into two parts and we'll be fine. All right. We'll be fine. Okay, so I'll share my screen and I'll go as slow as I can and you should be fine. All right. So taxation most, and we're looking at deferred tax component most especially. Okay, so we account for the current taxation in accordance with the relevant accounting standards. We explain the effects of taxable differences on accounting and taxable profits. So I'll end here for the first part. Okay, then the second part we'll look at how to record deferred tax in the statements, in the financial statements. All right. Now, um, so yeah, we split them. So we have every tax has two portions. The current tax, which we are all aware of, we know what it means, okay? And then the deferred tax component, okay? So for the current tax, what are the accounting entries? You recognize it in your statement of profit and loss, right? And then the other leg, if it has not been paid, we have to recognize it as a liability in our books, okay? But if we pay it off, then of course, our cash or bank account will have to be credited accordingly. In deferred tax, what we'll be looking at are the temporary differences which arise when we compare the carrying amount and then the tax value. Okay, what is the purpose of deferred tax? To reduce profits, to increase profits, to recognize the liability. What is it? Okay, so we'll look at accounting entries. Okay, now what I would say is this is a summary. This is a summary. Take a good look in the book, in the core text, and you have it everything there. Okay. All right, so tax in the financial statements are made up of two elements, like I said, the current tax, okay, which we are entitled to pay to the HMRC, to the tax authorities, okay, in relation to our current year's operating activities, whatever profits we make. Remember, we don't pay taxes on losses, we pay taxes on profits. So within the year, if you have made some provisional payments and it comes to the point that um, you have paid taxes when you've actually made losses, you claim for refund, okay? It's logical. When I don't make profits, I don't pay taxes. So the current year tax is looking at what we owe the authorities together with any under provisions or over provisions from the previous years. Now the fair tax is simply looking at an accruals concept, matching concept. Okay, we will look at that. Now the tax liability usually will bring it forward from previous year if we have not paid. But if payment has been made, then we knock it off, okay? Now, if the payment is not the same as the liability we owe, there will be a balance on the face of the trial balance at the year end, right? Okay. Now, this balance will represent either an over provision or under provision, and we write it off to the profit and loss as part of our current year's tax expense, okay? So the tax expense today in our books should be the current tax we expected to pay plus or minus any movement in deferred tax. The word deferred tax shouldn't confuse you. Take it as an ordinary English language. It is a tax you owe, but you've deferred. You pay it later. It's still a liability. Take it that way and you will understand it quite easily. Okay. So something I owe, I have deferred it and I'll pay later. It's nothing technical. All right. Okay. Now in the typical current taxation accounting, like I said, we will debit our income statement, okay, with the tax expense as income tax for the year. And then we credit the tax payable if we don't pay it instantly now. Otherwise, we'll end up paying or crediting what? Otherwise, we'll have to credit the cash or bank, okay, if we paid. instant. But usually it is carried forward so that the tax guys will come and check and see whether we have an over or an under provision to be sure that we don't overpay or we don't underpay, something to ensure some equity in the system. Okay, so the current year tax will only represent the estimate based on current year profit. And usually you will see 19% taxation rate or 30%. Okay, so it depends on the jurisdiction in the country. Okay, now what is deferred tax? Like I said, is the application of the accruals concept. Okay, so simply the deferred tax is talking about the liability for the liability for the deferred tax. So once again, let me take you one simple step back. Take it as a tax you owe, you've deferred. Okay, now the liability for this deferred tax will recognize the estimated future tax consequences. Okay, of the recognized transactions and events. Something I owe, I'll pay in the future. Now, what we have to do here is to look at any difference between the accounting and tax treatment of the item. Okay, any different, the carrying amount, how did we treat it in the books, the accounting treatment? What about the tax treatment of the same item? We look at the difference between. It will give rise to a temporary difference. In this point, if there is a temporary difference arising, we need to recognize a deferred tax. Okay, yes. But if there are no temporary differences allowed arising, there's nothing like deferred tax. Okay. For example, if we have some tax allowances, you buy a machine, you want to use it, the HMRC grants you a tax allowance on that asset. Then you know that there's some tax allowance you've recognized you've gotten compared to the current amount of the assets. If there's, then we can get the temporary difference. But if no, it's not allowed. You buy the machine, but the HMRC doesn't allow you, give you any tax allowance, then there's no deferred tax impact there. Okay, you move on with life. All right. Now, deferred tax will be calculated when we compare the carrying amount, like I said, of the asset or the liability, usually let's say an asset, to the tax base. Okay, what is the tax base? The tax base of an asset or a liability is its value for taxation purposes. It's just the value of the asset or the liability for taxation purposes. So it's always important to compare, to consider whether the carrying amount is bigger than the tax base or the tax base is bigger than the carrying amount. Okay. Now, if the carrying amount is greater than the tax base, there's a taxable difference. If the carrying amount is bigger than the tax base, there's a taxable difference which gives rise to the deferred tax liability. But if the carrying amount is less than the tax base, then we have a deductible difference which gives rise to a deferred tax asset. So liability and asset, they all come, you know what each one means as an asset and a liability, okay? So the calculation, so don't always think or see it to be in the light of only a liability. It can give rise to a tax asset, okay? The example we'll look at here will give rise to a tax liability. But you see how the adjustment works, how we reduce it over time, okay? Now, let's move on and see. The calculation of deferred tax is not examined usually within the financial reporting exam in ACCA. So for now, we'll be looking at, so we'll not be calculating this, but we'll be looking at the temporary difference on non-current assets. That's what we'll look at more. Okay, let's take an example. Then we'll use this one to wrap up for the first segment. And then we'll look at the recognition and how to present it in the financial statement. Okay. So like I said, let's focus on tax liability for now. So on 2012, 1st April 2012, Wealth bought a machine, 200,000. They will depreciate it over 4 years, useful life, straight line basis. The HMRC gave them an initial tax allowance, 100%, so the whole of this is granted. The rate of tax, actually, for Wealth is 30%. Explain the impact of deferred tax on their financial statements for the first year and the second year. So for year 1, right? And year 2. All right. Let's move on. Let's see what we can do. All right. So what we know is that the asset will be depreciated over its useful life. How many? 4. So simply our 200,000 divided by 4, giving us each year 50,000. Okay. Now the current amount in the very first year, year 1, 2013, is what? Our cost minus the useful life. So this is the cost. Okay. minus the depreciation. Sorry, did I say useful life? Minus the depreciation gives us the 150. This becomes our carrying amount, right? In the books. This becomes our carrying amount in the books. Now let's compare this carrying amount to the tax base. Okay. Now you realize that they received 100% tax allowance for the entire amount, okay, in respect of the machine. So the whole 200,000 was given. So what then becomes the tax base, the tax value? The cost 200 minus the entire 100%. So this is a 200,000 minus the entire allowance which was given 100%, 200,000. So the tax base is zero. The tax base is zero. Therefore, I need to compare my carrying amount, okay? My carrying amount, which is what? 150,000 against my tax base, okay? My tax base, which is zero. So my temporary difference will still be 150,000. And you remember when we stated here that when the carrying amount exceeds the tax base, we recognize a deferred tax liability. And that is the scenario we are finding here. Okay, so an entire deferred tax liability have to be recognized. So we need to simply find 30% of this, okay, which I think gives us 45,000 to recognize. Okay, all right. So the temporary difference between the two, like I said, 150. We need to then offset it by the tax allowance. Okay, on 31st March, we need to create a liability for the deferred tax to recognize the future liability to tax. So as we reverse these temporary differences, we need to reduce it as time goes on. Okay, but for now, it is 45,000. So the deferred tax liability, like I said, will multiply by the tax rate 30%, okay, which gives us 45,000. So what do? The accounting entries. We debit our income tax expense, and then we recognize the deferred tax liability as usual. Okay, that's the first year. Okay, now the effect of this is simply to increase our tax expense in our books and correspondingly also increase our deferred tax liability by the 45,000. Now each year, this temporary difference will have to be calculated, and then we see whether we have to reduce our deferred tax liability or increase our deferred tax liability. Okay, this movement will also be reflected in our income tax expense. Do we reduce it or we increase it? Okay, year two. Year two, remember what will be the carrying amount? We are told that the depreciation is 50,000. Okay, straight line, the 200,000, that was the 200,000 divided by 4. Straight line, okay? So it gives us our 50,000. So in year two, our carrying amount would typically become what? The 200,000 minus 2 years of depreciation. Okay, 2 years of depreciation, which is 50K for each year. So we end up getting 200,000 minus 100,000, giving us 100,000 as our carrying amount. Okay, once again, compare your carrying amount. So this is the carrying amount. Compare your carrying amount to the tax base. Okay, to the tax base. What is the tax base? It's zero still. Okay, so it is our 100,000. Okay, minus zero gives us a temporary difference again of 100,000. We must then recognize our taxation on it, 30% of the 100,000, which gives us what? 30,000. This should become the new deferred tax liability. But in reality, we have already recognized what? 45,000. So it means we must reduce this 45,000 to what? 30,000. And the difference becomes 15,000, right? So what do? Instead of crediting this, we need to debit the deferred tax to reduce it, okay? We debit the deferred tax liability by what? 15,000 to reduce it, okay? And then we do the same for the income tax expense. So you debit the deferred tax by 15 and you credit the income tax expense. Normally we would have debited income tax. So reduce the income tax expense by 15. Okay, that's the second year. So the effect of this adjustment will become what? Is simply to reduce the tax liability and the tax expense. Okay. Okay, we'll leave it here. So assuming you were working for the third year, year 3, you realize that it is your 200,000 minus 150,000, right? Which gives you carrying amount of 50,000. So your carrying amount, okay, carrying amount is 50K, right? Then you multiply by your 30% tax rate and see what you get. Is it 15? So you end up getting 15, which means you have to again proceed and reduce your deferred tax liability. Now it was 30, reduce it downwards, okay, and then you debit your tax liability once again, okay, your deferred tax. Let me make it deferred tax liability, and then again you credit your income tax to reduce it up downwards. Okay, I'll leave it here. Then we'll continue the next session looking at how to recognize deferred tax. Okay, possibly we can just look at that, and then when we come, we'll look at the measurement. Okay, in terms of recognition, deferred tax liabilities should always be recognized in respect of the taxable differences. Okay, for financial reporting, it is very key, likely to be limited to only those arising on PPE, okay, on non-current assets, usually, okay, on non-current assets, where we have the tax allowances granted to us by the tax authorities. Now, deferred tax assets, like I said, remember, it will not only be limited to the liabilities, we can get an asset component. Should be recognized in respect of deducting temporary differences, as long as we have sufficient future profits available to take care of these deductible differences. Okay, that's it for the recognition. Okay, now when we come to the second part, we'll look at measurement of the deferred tax liability, and then we'll take an example where it is represented in other comprehensive income. Then we'll look at asset revaluation to be able to wrap it up. Okay, on my clock, it is 17 minutes, I think, and that's okay. All right, so we'll take the next session, and all I'll say is support Liverpool. It is the best club. Okay, support Liverpool. It's the best. We may go for the quadruple. See you, friends. Bye.